Hi, good afternoon, everybody. Welcome to our quarterly asset allocation webinar. My name is Phil Huber, Head of Portfolio Solutions with Cliffwater, and today I'll be joined by Steve Nesbitt, Cliffwater founder and CEO. We'll leave plenty of time for question and answers at the end. Please bear in mind that today's webinar is for research purposes only and is not specific to any Cliffwater funds. So if you have any fund-specific questions, you're welcome to submit them. We'll just have to address them offline. Please also note that a copy of today's slides is available in the webinar portal or in the email that you received about 15 minutes ago. With that, I will hand things over to Steve, and we'll get started here.
Hey, thanks, Phil, and thanks everybody for joining us. I have just a few topics to cover over perhaps 30 minutes, then we'll do Q&A. Want to talk generally about the macro environment, the economy, government policy, then turn to historical returns on different asset classes, really to inform us on baseline expectations as to, hey, what is a required return for investing in bonds? What's a required return for investing in stocks and so forth? Establishing those baseline expectations, I'd like to turn to what our long-term forecasts are for asset class performance, what's called expected returns. And we look at these expected returns, compare them to our expectations or required returns, and that informs us as to whether perhaps we should lean into one asset class versus another. And then I'd like to turn to our model portfolio, something I've been presenting for the last two plus years, and then turn it over to you for Q&A. So all that's okay. Let's get on with it. On slide 3, basically, the economy is good, not great. We've had a pretty solid economic growth post-COVID, 2.3% per year. It's been volatile. Obviously, it's been a volatile time in Washington. A lot of different things going on, but overall, the economy keeps moving forward. Probably most important was 2022, 2023. Interest rates shot up because of unexpected inflation. Everybody was forecasting a recession, never came. So, now we're looking perhaps at another event, rising gas prices as a result of oil prices, and maybe that'll put us into a recession, maybe not, but the interest rate hike certainly did not. So we'll see how things unfold. In terms of growth rates across different economies, again, U.S. steady 2.3% as I went through. Pretty solid again growth. The rest of the world continues just to move sideways. I'm showing real growth rates here for the G7 countries. Again, on top is the U.S. Canada generally follows along the U.S. growth rate, and then but the rest of the world is pretty much flatlined over the last 15 years, particularly over the last 10 years. There really is not a bright spot among the rest, the G5 countries. Turning to focusing back on the U.S. Government policy, which obviously is influential on the economy in two ways: monetary policy and fiscal policy. This is monetary policy, and basically we're at what I would consider a neutral monetary policy. Again, post great financial crisis, interest rates were zero. Inflation was pretty much under control, between 2 and 3%. Real rates were negative, as you can see on this graph, the shaded area from most of those dozen years, but overall stimulative. That changed with in 22 with a spike in inflation, ramp up in interest rates. All of a sudden, the real rate of interest turned positive, significantly positive in the shaded area. If you can interpolate, it was about 2%, which is restrictive. The Fed was putting on the brakes. People were concerned about the impact on the consumer, the impact on levered companies. A lot of forecasts of recession never happened. Fast forward to today, we've gone through a series of rate cuts. We're at 3.64% Fed funds rate. Inflation got below 2%. So we were still in a restrictive, though less restrictive state. We had a spike up. The March number for inflation was annualized for the month like 8%. So that will likely turn out to be an anomaly. But right now, with the higher inflation, real rates again have become very low at 0.26%. The Fed is standing firm. Rate cuts. I can understand why they don't want to consider rate cuts at this time until they can get our inflation number that is sustainable. So basically, I would call it a neutral monetary policy. Fiscal policy is stimulative, continues to be stimulative. Obviously, the war is will add to the deficits, but again, supportive fiscal policy. The question is, will it become inflationary? Turning to leaving kind of the macro 40,000 macro view, turning to the capital markets. I again like to show a couple of graphs that I've repeated over several quarters. The first is basically the U.S. Capital markets have been pretty consistent when looking over a long period of time. U.S. stocks compound annual return really over a century, 10.4%. That there is PE expansion in those numbers. I don't want to take away from that, but about 2% of that is PE expansion. So if you're just counting fundamentals, 8.4% growth rate. Bonds at 5.2%. Bond returns have been less consistent because we've really gone through two completely different states. A state where interest rates rose during the first 50 years, and a state where interest rates came down during the second 50 years. Where we'll go going forward, don't know. But overall, the bond return at 5.2%. Notice it's about 2% better than the cash return. That makes a lot of sense. I'll refer to that more later, and about 2.5% above inflation. U.S. stocks, just want to make note, historically about 5% better than bonds. If you again neutralize the PE expansion over this period, it's more like 3%. Turning again, overlaying international stocks. Obviously, at least institutionally, people have been very interested in global diversification. I've talked about this before, particularly in our recent paper. If you might want to catch it in our research about the 60-40 mix, does it still make sense? But one of the risk factors is basically weakness in real growth rates in non-U.S. stocks. I'll talk more about that later in terms of earnings per share growth and EBITDA growth. But we had a good, non-U.S. stocks helped by falling dollar did well last year, 2025. So far in 2026, that none of that is due to earnings growth. It's all due to either currency or expanding PE ratios there. So I'm not sure to what extent it's sustainable. So basically, all this history informs us as to pricing for different asset classes. So from our point of view, we have these long-term expectations or required returns for the different asset classes. And again, we will flip the page and talk about where we sit relative to these required returns or baseline expectations. So if we start at a 2.5% inflation rate, right now our forecast is 2.3. But again, this is more generic, not date specific. But generally, if you take a reasonable starting point, inflation of 2.5%, you should earn a cash return. History tells you about 0.5% above CPI. So if we're talking about 2.5 for CPI, get 3 for T-bill. The term premium for Treasury bonds of a 0 duration versus a 10-year duration is about 1.5%. That's what it's been historically. So if you're dealing with 3 for T-bill, add at 1.5%, you get 4.5 for 10-year governments. If you're dealing jumping up to stocks, add another 3.5%. That gets you to 8% for stocks. Is kind of a required return or baseline return. Private equity, our premium we've always argued is 3%. That gets you to 11%. So basically, this first bar related to equity, I think I'll show you shortly that basically today's market lines up with these baseline expectations or required returns. If we look at credit, basically what history tells us we should have about a 2.5% premium for public credit over Treasury bills. So again, T-bill return 2.5 plus 0.5% gets you 3%, plus 2.5 gets you 5.5%. It's kind of the required return for public credit. This would be like the Morningstar LSTA US index. Private debt, what we've observed so far over the last 20 years is about a 4% premium. That would get you about 9.5%. I think our forecast right now for private debt modestly levered is more on the order of 8.9 or 9%, but not a great deal of difference. And in terms of high yield bonds, as opposed to broadly syndicated loans, they're priced off Treasury bonds because of duration risk. They're fixed rate. So the starting point there is the Treasury bond. I said that's 4.5. Add 2.5 expected premium, and that gets you to about 7. We're really not close there in terms of high yield bonds. They're probably, arguably, they're not providing near that today. We can draw conclusions later about that. Real estate or infrastructure, that's priced off equivalent duration Treasury bonds. So again, Treasury bonds at 4.5 works. Add 3, we expect 7.5 for real estate infrastructure. I'll talk a little bit more about that later, but we're starting to get to the place where cap rates are close to 6% now, and where real estate is becoming reaching the equilibrium rate of return. And then hedge funds, this is more alpha oriented off Treasury bills. Again, it's basically a cash rate plus an alpha spread, a little bit of beta in there, but this puts you at 3 plus 2.5, 5.5%. That's probably doable across a diversified hedge fund portfolio today. So establishing that from historical realized returns over long periods of time, let's turn to our expected returns. And if this is our methodology for measuring forward-looking expected returns, our horizon is generally 10 years, and our return forecast is really a function of the current cash yield. A cash yield can come in different forms, and cash flow growth. Cash flow growth can be either positive or negative. In the case of credit, it's generally negative, it's just a degree of negative. And on equities, it's positive. And again, different rates of positive growth. Many other people incorporate valuation changes. For example, many of the allocators today think PE ratios are too high. They will incorporate some degradation in PE ratios over time, which may take away from the two strategic components. You can also incorporate manager alpha. Sometimes for example, our private debt forecast will assume a manager can through active management reduce loss rates or smaller negative in terms of cash flow growth. Let me give you an example. So here I'm talking about public REITs, which are really interesting because they basically, because of get REIT status, they distribute about 90% of their earnings. But what I'm showing here is their dividend per share. And most people focus on the dividend. Okay, today that's 4%, but it's interesting. Dividend growth has been positive 1.9%. Over the last 35 years. Zigged up and down, but real growth in dividends has actually been negative. And that's at face value, that's a little bit surprising because normally you want dividends to stay stable as on a real basis. This is again on this blue line adjusted for inflation. So basically, dividend growth is less than inflation, the rate of inflation. That at first blush would cause you some concern. And it's supposed to be an inflation hedge. But then if you look at NAV growth, both nominal and real, so if you look at that real in blue, NAV growth, normally if you're distributing all the earnings, there is no real growth in NAV, but REITs have been able to produce a modest but not insignificant growth in real growth in NAV at 1.8%. You subtract that 0.8 from dividend decline, basically you get net 1%, and that's demonstrated in the next slide 13. So when we're developing an expected return for REITs, okay, again, goes back to cash yield plus cash flow growth. So basically, our expected return is this simple arithmetic. We start with expected inflation of 2.30%. Again, we expect that's the starting point. We expect all the growth curve to always start with the rate of inflation. Add real NAV growth from prior page at 1.8%. Add the dividend yield at 4% as of March 31, and then real dividend growth was minus 8%. So you put all that together including both the history to develop some of these growth assumptions, plus current inflation forecast and the current dividend yield, you get 7.3% for REITs. Let me turn to stocks. On our last call, I talked a lot about current dividend yield and buyback yield. So cash flow, not on this page, but cash flow is a combination of dividend yield and the buyback yield. Here, I'm focusing on growth, and basically on the last call, I talked extensively about the long-term growth of earnings per share or net income growth for the U.S. versus non-U.S. And basically I said, hey, growth rates, earnings per share growth rates have been much higher in the U.S. than non-U.S. So I updated those numbers for 2025. It takes a while to get numbers, particularly for non-U.S. companies, because many of them report very late, or they report every 6 months. So, we get much more timely information on U.S. companies than non-U.S. companies. But anyway, after some delay, we are able to produce these numbers. Let me focus on EBITDA, the first two columns, because EBITDA, I think, is a much better measure of earnings power than net income. I won't go into why right now, but take my word for it for a second. So the U.S. it has been growing, the U.S. Stock market, and here we're looking at the top 500 companies. It have been growing significantly, and not only in 2024 up 11.6%. But also now that the numbers are in for 2025, up 10.99%. Let's compare that. That's in the shaded area. Let's compare that to the non-U.S. So everybody was excited about, I can't remember, 20%, some significant return on non-U.S. stocks last year. Oh, gee, they, hooray. But if you look under the hood, basically earnings growth measured by EBITDA continues to be anemic. Basically, barely positive in 2024, which I talked about 1 or 2 quarters ago. The 2025 number is 1.6%. So again, 10.9%. For the U.S., 1.6% for the non-U.S. And you can see the individual different breakout in the non-U.S. The only country that had a surprisingly positive result was the UK, coming off a 5% decline to a 10% growth. That was primarily AstraZeneca. So again, for long-term return, you're not going to have sustained multiple expansion as you did in 2025 with the non-US without realizing some significant earnings growth, and really not so much in 2025 outside the US. Again, yes, the MAG 7 did contribute significantly. EBITDA growth in 2025 was almost 25% for the MAG 7. But even if you exclude the MAG 7, you're looking at a 7.7% EBITDA growth for 2025 well above the non-US 1.6%. If on the far right-hand side, I'm looking at price to EBITDA. Again, the non-US did well because in 2025 versus 2024, multiples increased by almost 30% in outside the US versus maybe 5% in the US. Okay, so reviewing REITs, reviewing equity, these are important. I reviewed REITs to show you how the calculus is done. We reviewed the equity, the global equity market, because growth is so important to so many asset classes that I wanted to review that again. Anyway, reviewing asset class performance and our expected returns, Q1 2026, that I think it's called the third column, Q1 2026. This is already out of date. It was a risk-off market. April made it turned it back into a risk-on market. So that you don't attach a lot to these numbers. But I just want to say that REITs have revived themselves. We at least we're starting to believe that REITs are now in equilibrium, potentially have a good path, forward. Talk a little bit more about that later. In terms of illiquid investments, private equity and private real estate continue to struggle. I'm looking 2/3 down the page under the alt section. So private equity, 6.9%. That was the trailing 12-month ending December. So that's basically the 2025 return. Struggling a little bit. I will say this is buyout number. Ventures over the last 2 quarters of 2025 is really shooting the lights out, 20+%. So again, I'm talking about buyouts in that venture. Private real estate still is struggling. Unlevered return of 4.9% in 2025. If you look at the far right-hand side, we're starting the most recent transaction cap rate was reported at 5.95%, so about 6%. So if you remember, that got down into that had a 3 handle not too long ago. Private debt again performing well. Last year we reported our CDLI index at 9.3%, very low loss rate. So unlevered, very good return. The levered numbers, which are indicative of BDCs, were 8.3% for calendar 2023. Again, a very good return, but not the double-digit returns that we became accustomed to when Fed funds rates were above 5%. Let me just move to the next page. So, I'm going to go back. I apologize. So our expected returns shown in the far right-hand, second to the right-hand column, and then their explanation on the far right-hand column are shown in gray. I won't go through these except to say that they're very consistent with the required returns or the baseline returns we presented earlier. So from my point of view, the capital markets are basically in equilibrium in terms of pricing. It's not, hey, let's lean this way, let's lean that way, and we're basically would be arguably pretty neutral in terms of allocations at this time. So I'm turning now to some of you have seen this before. Basically, it's okay. This is what Cliffwater thinks. How about the other allocators in the world? So I sampled from 15 of the largest allocators out there. You can look at the bottom and get the names, and then compute their average return expectation, again, 10-year return expectation, and their 10-year risk expectation, and then plot them. And then I fit a curve shown in the dotted line. A couple things interesting. These are basically, these are big institutional investors making forecasts. They like private debt. These are as of year-end 2025. Okay, so these are like, starting 2026 expectations. than over the next 10 years. But they like private debt. If you want to take some risk, they like private equity. Those two asset classes reflect significant premiums over the public asset classes shown below. Infrastructure probably rates number 3 in terms of attractiveness. Maybe it's better than private equity. And, it depends on how you slice and dice this stuff. The other interesting observation is experts out there or allocators out there really don't like U.S. stocks. Our forecast is like 8. Last quarter, comparable time period, we were 7.8 at the January 1, but they're at 6.04. So basically, they don't believe the growth story that we're seeing. Some of them make mistakes. They don't include buyback yield, but basically that they either don't see the growth, or many of them incorporate spread tightening, spread tightening, PE contraction over time. So basically, they may have a higher expected return based on fundamentals, but they expect PE ratios to come down for U.S. stocks and go up for non-U.S. stocks, or at least on a relative basis. They still, their forecast for real estate is becoming a little more interesting, but it's slowly moving out. And this is a slide 17 here. You've never seen this before. Basically, I rank order these asset classes with CPI from lowest risk to highest risk, using a risk number, the average risk number on the prior slide. And then what I'm showing here is across the 15 in the survey, I'm showing the range of expectation for each individual asset class. And so, the forecast for CPI, everybody's about the same at, 2 to 2.5%, call it. Everybody's pretty much the same on the cash, tight distribution. Everybody's very tight on fixed income. Basically, they're using the yield to worst or yield to maturity number. Then all of a sudden, you're starting to get some dispersion for hedge funds, high yield. I'd like to point out private debt. There is some dispersion here. You got a real outlier on the upside. But basically, the consensus here is pretty tight. So if I'm looking at the distribution of private debt, and if I don't like private debt, if I'm going into U.S. fixed income, 201, they all agree private debt over the next 10 years is going to do a whole lot better than traditional U.S. fixed income. Where real estate is a step down, okay, admittedly, with some distribution. Infrastructure, there's a wide range of expected returns, but the 7.5 is not bad. And if you look at the range, whether the high or the low, it looks like a pretty attractive asset class. Maybe not as much as private debt, but pretty attractive. And you can see why money's flowing in there. And U.S. stocks, again, a high range of return, but no one is super excited about U.S. stocks. EFA stocks, that distribution looks about the same as for U.S. stocks. Private equity, people like private equity. That's why these institutions are allocating. In emerging markets, has fallen out. So anyway, basically, we see equilibrium. If you look at this, and if you're interested in individual forecasts, there are some kind of strange results by allocator, but overall, it's kind of what you would expect. The private's doing better than the publics. And I've shown this chart before. I'm going to wrap up here in 1 minute. This is the stock bond spread. I talked about basically a 3.5% spread kind of being normal between 10-year treasuries and expected return on U.S. stocks. That's pretty much where we sit today. That spread has gone in different directions. Last decade, we were leaning in heavily into stocks because the spread was much higher. It sits today at 3.70%, which is basically really close to the 3.5% required return. So, if you're dealing with a 70-30 mix, 60-40 mix, we see no reason to go make a tactical shift one way or the other. And finally, the model portfolio, we made a couple of changes. We started in December 23. We made two very modest shifts in June of 2024 and December 24. We apply, hey, if we're investing in these asset classes, how would we invest in a very kind of semi-passive way or very diversified way? Show the return over the last 2.25 quarter years. You get 12.9%, and then we show what a benchmark 60-40 U.S. stocks, 60-40 global stocks, what would it produce? I know at the last call, someone asked us to produce a taxable version of this. I owe you that. It's a little more complicated than I first thought. It has to do with rebalancing, timing and rebalance, all of this. But anyway, on our next call, I'll have that for you. So with that, thanks for your patience. Let me turn it over for Q&A to Phil.
Excellent. Thank you, Steve. Maybe a good place to start, I think, would be, to say it's been a headline-rich environment this year for private debt would be probably an understatement. Can you just give some commentary on what people are reading in the press and where the biggest disconnects are relative to underlying credit health fundamentals, et cetera?
Well, the commentary has shifted over time. It was originally about, hey, the quality of the underlying loans, okay, the cockroach commentary. So, the data since those original Tricolor and First Brands defaults, like I think about a year ago now, and all the concern about problem credits, all the data that's come in since has disproven that fear. Okay, so and we report. You can go back and listen to our webcasts on CDLI, but loss rates are extremely low, well below the long-term historical average. As I say, the long-term historical average is loss rate is 1% per year. Okay, we've been at about I think we'll come in at 50 or 60 basis points for last year, so kind of half the historical average. But that got a lot of press, scared people that the asset class is tumbling. Okay, and so that was narrative number one. Narrative number two was, oh, gee, not only that, but our private credit is systematic, can be a systematic risk to the whole banking system, cause another financial crisis. So you had a lot of yellow journalism regarding that. And all of a sudden, particularly this week, but started before that, all the bankers and people in government, we haven't heard final things from the Treasury or the Fed, but basically they're going to conclude, hey, there's no systemic risk here. Okay, get off it. And definitely the bankers are telegraphing that now. So that narrative is dying. The third narrative is, oh, okay, credit's safe, it's not systemic, but you people that offer semi-liquid funds, you have a liquidity problem, okay? So it's going to take a few quarters for that narrative to die. It will die. But basically, as I've said repeatedly, most of us that do these semi-liquid funds offer quarterly liquidity up to a max of 5%. Some of us have gone to 7% because we can. That's not a permanent state. But basically, liquidity of private credit is, unless you mismanage, okay, unless you're a bad manager, okay, and most of the people who are doing this are fairly sophisticated. What provides for liquidity to meet redemptions, it is the cash flow off the portfolio. Cash flow off a private debt portfolio averages historically 8% per quarter. I've written about this so many times. And we get this information not only from our CDLI index going back 20 years, but also from our own management experience. Okay, so it averages 8, but it can go down. So if it averages 8 and we're offering 5, we have a 3% cushion. You have to stress test it because it's quoted cash flow has been above 5%, except for 2 quarters. The first quarter was Q4 of 2008, the great financial crisis, where it went down to 3.5%. So if you're offering 8, this is a hypothetical, but if you were offering 5, you only got 3.5% in fourth quarter of 2008. You had to have some facility backstop to get you to fill in 1.5%. I won't go into all the backstops, but everybody who does this has very sufficient backstop. I will say in 2008, after fourth quarter and the first quarter, it went back up well over 5%. I can't remember the exact number, but these things, if it falls below 5, it's very short-lived. The other was during COVID. And no, excuse me, it was during the interest rate hike, and it went down to, I think, 3.7%, 3.7 or 3.8. But then again, it quickly reversed itself. So people talk about lines of credit, blah, 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 uncommitted capital, blah, blah, blah. But it basically, none of that really matters unless you're just mismanaged. It really comes down to the cash flow off the portfolio. That's not coupon income. Interest income is immediately distributed to investors, so that doesn't count. And we don't need to count new sales. It's basically you got a portfolio. How much cash flow in principal repayments and refinancings? How much are you getting per quarter? So there's more than ample regular cash flow. So providing the 5% is basically a slam dunk. Will investors continue to be spooked, believe the Wall Street Journal and Bloomberg? If they want them to manage your money, hey, put in your redemption, but they're going to be wrong, and this story is going to go away. But unlike the other earlier narratives, which have pretty much been dispelled now, it's going to take a couple quarters for the liquidity narrative to dry up. Sorry about that long.
No, that's very helpful. Obviously, a very important topic today. So, for those that are listening, Steve posted an article earlier this week called 10 misconceptions about private debt, I would encourage you to go take a look at that. It's posted right on our homepage, and more expansive commentary on those topics as well as a handful of others. So let's see here. I guess sticking with direct lending, you had the slide earlier of all the different capital market assumptions from the different allocators. The question was, is the private debt assumptions just direct lending only, or are these other CMA providers using distressed debt, asset-based lending, mezzanine, et cetera, as part of that?
This is direct lending.
Yeah.
So sometimes they break down forecasts for distress or for opportunistic, but I'm just collecting here their direct lending. All of them produce an expected return for direct lending. So this is the direct lending number. Normally they'll put a 1 to 2% premium on, the higher risk stuff.
Okay. Let's do a question on real estate. We've talked a lot before about the meaningful premiums in private debt relative to public credit, private equity relative to public stocks. How do you think about, there maybe isn't as much evidence around private real estate relative to public real estate. What have you seen historically in the institutional world around real estate allocations, how they get sized in a portfolio, where allocators are sourcing them from, and what that mix of public versus private might look like optimally?
Well, real estate was the first, and for the longest time, the darling alternative investment for large institutional investors, and producing a return that was cyclical, but reasonably attractive over a long period of time. So what I mean to be reasonably attractive, it was somewhere between equity returns and bond returns, and with very low level of risk. The way institutions historically invested in real estate was pretty much unlevered. There might have been some financing, look-through financing, but it was pretty much low risk stuff, fully leased, what we call a core. During the 2000s, all of a sudden, real estate took a turn from open and closed-end funds to these partnerships, which put on quite a bit more debt, became more opportunistic, took more risk. All of a sudden, they started charging incentive fees or carried interest. They got jealous of the private equity world, and those funds really mixed results at best. And then we hit the great financial crisis, and basically real estate is basically has struggled. In most cases, there have been some better performers, but it's been a struggle over, I'd say, the last 10 years. I will say REITs, because they had those capital market discipline, REITs have generally performed in line with U.S. stocks. They use more leverage, so they are riskier. They use leverage, but the discipline of the public market seems to have helped them. So REITs generally have done better than the real estate funds over their the last 40 years, over the last 20, over the last 10. But they can be extremely volatile. You can lose 70-80% of your money as you would have during the great financial crisis. Although it rebounded, it's like public BDCs. Good long-term performance, but very volatile.
Great.
Did I answer your question, Phil?
Yeah, I think so. We'll move on to another topic here, which is a question around the mix of U.S. and international stocks. In our models, we have a big overweight to U.S. relative to global market capitalization. And the question is, given the very similar expected returns, should the weightings be even closer to market cap weighting because of that, relative, against the recommendation we have on large overweight? How do you think about that?
Well, if I'm looking at these numbers on this slide 16, these allocator numbers, okay? Basically, or even if the US stock number was a little bit better, hey, I diversified. All the expected returns are all pretty similar. Let's just diversify. Let's use global cap rates. But if you look historically over the century, non-US stocks, because of their poor growth rates, earnings growth rates, their performance is well below US stocks. So if you're looking at the fact is that international stock allocations have been maybe the most important factor in performance over the last 25 years. The more you had in non-US stocks, the worse performance. John Bogle had it right when he said in 2000, I think it was the year 2000, goes, there's no real need to diversify internationally. Now that runs because basically you get international exposure to US stocks. He was absolutely, that was prophetic. But things can always change, and there's, diversification has other purposes. But, and we overweight US stocks for a couple of reasons. One is we just think the future return on US stocks is going to be better than non-US stocks, just because of earnings growth rates that are unchanging. And second is diversification really hasn't helped that much, particularly in a recession or a downturn. Basically, correlations go to close to 1, and so you don't get an advantage in non-US. I got to pinch myself arguing against global diversification, but it's those are the facts. So anyway.
Yeah, no, I think that makes a lot of sense, and especially given the fact that they're not adding much of anything in terms of downside protection during some of the severe corrections and bear markets we've had over the last decade. And so if part of the reason of having a healthier non-US allocation is to maybe have a little bit of insulation of big market sell-offs. It just hasn't been the case over time.
Yeah, and maybe tax loss harvesting is a big thing, and don't pretend to be an expert in that, but basically having more stuff to trade or to harvest, maybe that suggests a more global portfolio, but I'm not exactly sure of that.
Audience is a bit shy today. If anyone has other questions, please submit them. I'll throw one more thing out there just in anticipation of next quarter when we do a bit of a deeper dive into a taxable model portfolio. What do you see investors making the biggest mistakes with as it relates to, well, we'll say, letting the tax tail wag the investment dog? Or are investors too concerned about taxes and that they create suboptimal portfolios? Just any thoughts you might have on that topic?
I don't have a lot of thoughts. I mean, that's a very important but broad discussion. It involves what asset classes are most tax efficient, what are least tax efficient. So, for example, one of the reasons I don't have a taxable version today is we're studying hedge funds and the tax efficiency of hedge funds. So we got to do some and are doing some original research on that. The second is rebalancing. So rebalancing, supposedly you got to realize gains, which is taxable, taxable event. When should you do that? Most people look at it year end, but maybe that's the least. Anyway, it's complicated. So I don't want to shoot from. That's a very good question. I don't want to shoot from.
We'll tease it for next quarter. A couple more have come in here. I know we got about 5 minutes left. So would you ever consider a strategic allocation to gold? What about Bitcoin?
Well, For my personal account, yes. Maybe less so Bitcoin. Gold is an unreliable hedge, but half the time it's a really good hedge, and there is a real return. So basically, gold, if you look over a long period of time, it hasn't done as good as the U.S. stock market, but there's a real return. There has been a significant real return to gold. On the last call, I showed what that was. I can't remember the number, 4 or 5% real return to gold. So I might consider gold, but Bitcoin, I just have no idea. So it's still difficult for me to wrap my mind around it. There are smarter people, I'm sure, but gold is something I might do in a personal account. From an institutional fiduciary point of view, it's very difficult to make an allocation to gold because there's no yield, no cash flow. It's fundamentally it's hard to analyze.
And I think behaviorally too, it's a tough allocation to hold on to because it tends to go nowhere for a while, and then you have these short bursts of big moves up and down, and people tend to chase in either direction, and so they end up not even obtaining the diversification benefits because poorly timed allocation decisions. So any comments as it relates to evaluating tail risk in an asset allocation model?
Yeah, so these are stress tests. So we have an optimizer. We evaluate tail risk. Particularly in 2022, 23, when inflation took off, we measured inflation tail risk, unexpected inflation. What is the tail risk in a portfolio for individual asset classes and for a portfolio? So basically, we call it 3 sigma test. So it's a worthwhile exercise to do. If anybody's interested in how we do it, be glad to set up a call on that.
Great. Why don't we pause here? I know we're close to the hour. There's a couple questions we'll address offline. But thank you everyone for joining us today. We'll see you in a few months for the next quarterly allocation update. And then, Steve, any final closing comments from you?
Well, appreciate everybody's support and time. Listening into the asset allocation webinar, and this has been a time where we've seen the need to communicate with a greater frequency and greater depth. Hopefully, that has been helpful to you all, and we'll keep. Our plan is to keep that up. So, thank you.
Great. Have a nice afternoon, everybody.